Let me bring in Dhirendra Kumar now, the CEO of Value Research and our in-house mutual fund expert. Dhirendra, thank you so much for joining us on Investor's Guide. Let's go straight to our portfolio versus portfolio segment. Deepak Arora has written in, he's 37 years old and he wants to invest 30,000 rupees every month in mutual funds, Dhirendra. He has 8 lakh rupees in his Provident Fund and he's been investing 20,000 rupees in infrastructure bonds over the last 3 years. Now he pays 24,000 rupees as premium on his life insurance policy and he wants to know where he should be investing his money to get good returns over the next 20 years. He also wants to know how he should at this point diversify his portfolio across the various large cap, mid cap and small cap funds, and how often he should revisit his portfolio to make sure it's on track. So let's start with the fact that he's 37 and he has a 20-year horizon. Which of our portfolios do you think will match his needs best?
I would say, our aggressive growth portfolio or growth portfolio, either of the two. But I would suggest that, he should ignore the fixed income allocation of this altogether, simply because he has to look at it holistically. His Provident Fund contribution is a fixed income. His existing investment in the infrastructure bonds, of course, it won't be on an incremental basis. It will be a very tiny component of his overall savings. But that is also fixed income. So I would say that he should look at these two portfolios.
We always talk about the fact that you have to review your funds annually, and this is the question he has as well. Now, if he's re-looking at the funds he invests in with a 20-year horizon, what should he be looking for in that annual review every year? At what point should he decide that he needs to tweak that investment and change it, or maybe redeem his money out of one of those funds?
There are two reasons why one should review it. One is the allocation goes haywire. You started with a aggressive portfolio with an intent of 10% into fixed income, 90% into equity, and if equity goes up or equity goes down dramatically and your allocation changes, maybe it is time to rebalance. The reason why the funds were invested, do they have the same characters? Are the variables still in place?
Alright, Deepak, that's the advice you're getting. Remember, our aggressive portfolio, which is on your screen right now, so you can write it down, is designed for a young investor with a long-term horizon who can take on some risk. Now, if you don't want to take on that risk, there's our growth portfolio, which takes on less risk, but will also give you stable returns. And Dhirendra, they're saying that you don't need to use the fixed income component of the portfolio because you already have your Provident Fund investment. Good luck, and write back to us if you need anything else. Let's move on now to our hold or sell segment. Ajay has written in from Australia. He's 32 years old. He's an NRI. He's been investing 10,000 rupees every month in mutual funds through SIPs. Now, he has a 10 to 15-year horizon, and his goal is to make his money double by then. Now, he sent us a list of his funds, Dhirendra. He wants to know if these are the funds that will allow him to double his money in 15 years. The first on his list is the DSP BlackRock Top 100 Fund. Is this the fund he should be banking on?
Yeah, DSP Top 100 is an excellent large and mid-cap fund. More tilted to large cap, and DSP Top 100, of course, has the potential to deliver much more, given that over this kind of time frame.
The next on his list is HDFC Top 200 and HDFC Equity. Now, you normally suggest that an investor consolidates from the two funds. Would you recommend HDFC Equity between the two?
Absolutely. For his time frame, that I think will be a better bet, and he should stick to his plan. And HDFC Equity has proved to be extremely rewarding for investors who have stuck through the lean times, continued investing.
The Birla Sun Life Dividend Yield Plus is the next on his list. This would be a nice complement to the two funds that he already has, wouldn't it?
It won't only be nice, it is a very desirable component. It's a different strategy at work, and I think it is important to have a different strategy as part of your overall portfolios. So yes, and Birla Dividend Yield Fund is an impressive fund.
Last on his list is the Reliance Pharma Fund. Dhirendra, would you recommend for his horizon that he takes such a specific exposure to a sector?
Pharma is a relatively stable category, and this is a well-performing fund. It is also fairly venturesome with its big bets in some companies, which has proved very rewarding. But if it is a very small component of his portfolio, not more than 5-7%, it's fine. Otherwise, no, it is undesirable if you are investing passively over the next 15 years.
All right, and his last question to you, Dhirendra, is he wants to know if it's the right time to invest in NRE fixed deposits, considering the rupee is depreciating. Well, we know that the interest rates on those deposits have been very high. They might be coming down in the future. Should he make the most of this opportunity and put some money away?
Yes, for all NRIs, this is a privilege to be benefiting from their Indian connection. But that apart, I think, he should look at it purely as his fixed income allocation. And if he's investing for many, many years, I'm confident that, equity will prove to be better performing asset class.
All right, Ajay, good luck with those investments. Write back to us if you need anything else. Dhirendra, we have a quick question that's come in from Suresh Mankani, who's written in. He's putting 22,000 rupees every month in HDFC Top 200 and HDFC Equity through SIPs. Now, he also tells us he has 1 lakh rupees put into the JP Morgan Smaller Companies Fund, which he put in as a lump sum investment. Now, he has a target. He wants to accumulate 12 lakh rupees in the next 4 to 5 years, and he wants us to help him understand whether these are the funds to do that. Now, from simple calculation, just the investment amount will accumulate to about 14 lakh rupees in 5 years. So, do you think then he should be changing the exposure he's taking, because a smaller companies fund might be too risky for the short term?
Yeah, this smaller company fund is an undesirable thing for his, his 5-year time frame. That apart, his portfolio of 2 funds, his investment in 2 funds is very low on diversification. Something happens to HDFC Equity, then all his investments are there. I would say, spread out. Even if you have, if you are tilted to HDFC, maybe 30-40% of your money going there, remaining money should go elsewhere. And from that standpoint, I would say that, he should choose our conservative fund, our stable growth portfolio, the portfolio built with 4 balanced funds. That will be an extremely stable, steady take on growth.
All right, Suresh, we hope that helps. Remember, if you have a question for Dhirendra, write to us on the email ID that's at the bottom of your screen. You can also reach us on our Facebook page.